You check the news. The S&P 500 just hit another all-time high. Everyone online is celebrating. Your coworker mentions his portfolio is up 20% this year, and you open your own brokerage app expecting to feel that same excitement. Instead, you see a number that barely moved, or worse, a number that's actually down. And you think, wait, how is that possible? The market is going up. Shouldn't my money be going up with it? Here's the uncomfortable truth nobody wants to say out loud. The stock market can have one of its best years ever, and the average person investing in it can still lose money, or at the very least massively underperform it. And it has almost nothing to do with which stocks you pick. In this video, I'm going to show you exactly why this happens. Because once you see the pattern, you'll never look at market headlines the same way again. If you've ever felt confused watching the market rise while your own account didn't move the way you expected, hit subscribe, because this explains one of the most misunderstood parts of investing. Let's start with the data, because this isn't speculation. Every year, a research firm called Dalbar studies actual investor behavior compared to market performance. And the findings are almost the same every single time. Over the past 30 years, the S&P 500 has averaged close to 10% annually. Meanwhile, the average equity fund investor has earned significantly less, often somewhere around 6 to 7% annually. That gap isn't small. Over decades, a few percentage points of difference compounds into hundreds of thousands of dollars. So the question becomes, if the market returned 10%, how did the average investor only capture 6 or 7% of it? The answer isn't bad stock picks, it's behavior. Here's the first and biggest reason. Investors buy high and sell low, almost by instinct. When the market is rising and headlines are excited, people feel confident, so they invest more, often near the top of a run. When the market drops, fear takes over, and people sell to stop the pain, often near the bottom. This isn't a small group of unlucky people. It's a pattern that shows up across almost every market cycle. Think about it this way. If the market gains 10% one year and then drops 10% the next, someone who stayed invested the entire time is roughly back where they started, minus a small amount from compounding math. But someone who sold during the drop and waited to feel safe again before buying back in often misses the recovery entirely, because markets tend to bounce back sharply and unpredictably, frequently before it feels emotionally safe to reinvest. This leads to the second major reason. Missing just a handful of days destroys long-term returns. Historical data shows something remarkable. If you were fully invested in the S&P 500 over the last 20 years, you captured the full average return. But if you missed just the 10 best trading days during that same period, a tiny fraction of the total trading days, your overall return would have been cut dramatically, in some studies by more than half. And here's the part that makes this so brutal. Many of those best days happen immediately after the worst days, right when fear is at its peak, and most people have already sold. This means the exact moment that feels most dangerous to be in the market is frequently the moment right before some of its strongest gains. Investors who panic sell during a crash don't just lock in their losses. They often miss the recovery that would have made them whole. Here's the third reason, and it's less about emotion and more about a psychological trap called recency bias. When markets have been going up for a while, people assume the trend will continue indefinitely, so they pile in near the top. When markets have been falling for a while, people assume the decline will continue, so they sell near the bottom. In both cases, investors are essentially extrapolating recent momentum into the future, which is precisely the opposite of what disciplined investing requires. The market doesn't care what just happened. It resets constantly. But human psychology treats recent events as a preview of what's coming next. And that mental shortcut costs investors enormous amounts of money over time. Now here's the fourth reason, and this one is sneaky because it feels productive even while it's hurting you. Excessive trading. Many investors believe that actively managing their portfolio, buying, selling, rotating between sectors, chasing trending stocks, is how you outperform the market. In reality, research consistently shows the opposite. The more frequently people trade, the worse their average returns tend to be, largely because every trade introduces a new opportunity to be wrong about timing, and because trading costs and tax consequences quietly eat into returns that... A famous study on this found that the more frequently individual investors traded, the lower their net returns were, even when their stock selection skill was roughly average. Simply put, activity feels like control. But in investing, it frequently works against you. Let's bring this together with an example. Imagine two people, both starting with $50,000 during a 10-year period where the market averages 9% annually. Person A invests the money and does absolutely nothing. No panic selling, no chasing hot stocks, no trying to time entries and exits, just consistent exposure to the market. Person B tries to be smart about it. They sell during downturns to avoid further losses. They buy back in once things feel safer. And they occasionally move money into whatever sector is performing well that quarter. 10 years later, Person A's investment has grown to roughly $118,000, simply riding the market's average return. Person B, despite genuinely trying to make smarter decisions, ends up somewhere closer to $85,000 to $25,000. Not because they made one catastrophic mistake, but because a dozen small emotional decisions compounded against them over time. The market went up the entire decade. Person B still underperformed it significantly. That's the paradox at the heart of this entire video. So what's the actual fix? It's almost disappointingly simple, which is exactly why so few people stick with it. The investors who capture close to the market's full return are the ones who remove decision-making from the equation entirely. They set up automatic contributions. They choose a diversified, low-cost index fund. And critically, they commit in advance to doing nothing during downturns because they've already decided ahead of time that short-term volatility isn't a signal to act on. This sounds almost too boring to be a strategy, but that's precisely the point. The market has always rewarded patience far more reliably than it rewards activity. Here's the mental shift that actually works. Stop thinking of market drops as emergencies that require a decision. Start thinking of them as the price of admission for long-term returns. Every investor who has ever earned strong long-term returns has sat through terrifying drops along the way. The difference isn't that they avoided the fear, it's that they didn't act on it. So here's the truth this entire video comes down to. The stock market isn't rigged against ordinary people. Human psychology is what works against ordinary people inside the market. The market itself has reliably rewarded patience for decades. The real obstacle standing between you and market average returns isn't your stock picks, your timing skill, or your knowledge of the economy. It's your own reaction to fear and excitement, played out again and again across every single market cycle. If this video changed how you think about market swings, hit subscribe, because understanding this one idea can save you more money than almost any stock pick ever could. And I'm curious, has fear ever made you sell something you later wished you'd held on to? Let me know in the comments, because almost everyone has a story like that, and recognizing the pattern is the first step to breaking it.